Good afternoon, everyone, and welcome to today's Veteran Alliance webinar on VA home loans. My name is Matthew Stanton, and I'm the operations manager here at Veterans Alliance. I want to start by thanking each of you for joining us today. Whether you're a veteran, active duty service member, a military spouse, or someone looking to learn more about VA benefits, we're truly glad you're here. At Veterans Alliance, our mission is simple: to serve those who've served. We do that by connecting veterans to benefits, education, and resources they've earned, and by creating spaces like this where information is clear, practical, and accessible. Today's webinar will walk you through everything you need to know about the VA home loan process, from eligibility and applying for a certificate of eligibility to understanding your entitlement, finding the right lender, and using your benefits to achieve home ownership. I will now start this webinar off by handing it off to our speaker, Robert Keeling, and let's get started.
Sweet, thank you, Matthew. Yeah, it's great to be here. I appreciate the invite and the opportunity to speak and hopefully educate on some things you didn't know and solidify some things you did know. There are a lot of myths out there and misconceptions about the VA loan, and one of my personal projects, I suppose, is ensuring that all information that's actually accurate gets put out as much as possible to try and squash down some of these myths and misconceptions. So without further ado, we'll get into it. My name is Robert Keeling, former Army sergeant. I was an intelligence analyst in the Army for about 7.5 years. About a year and a half before I got out, decided to give lending a whirl because I enjoyed real estate, bought a few homes with my VA loan, and wanted to make sure that everyone else got the same opportunity, because not a lot of people know about all of the options and all the things you can do with the VA loan. All right, so this is gonna be a crash course, by the way. It's not gonna be anything too into the weeds, but it should give you a good generalized information on almost everything to do with the VA loan. By all means, at the end, if we have any questions specific to certain things, drop them in the Q&A or save them for the end, and I'd love to answer those. So let's start with the loan process as a whole, right? Because sure, you buy a house, right? Sounds pretty easy, and it is relatively easy. However, there are a good bit of steps involved. First off, we're going to get pre-approved. Pre-approved means working with a lender. They're going to check over your finances. They're going to check your income, your debt, your assets, everything together, and they're going to figure out where your loan amount, your pre-approval amount sits, right? Whether that's $100,000 or $100 million, right? Next up, once you're pre-approved and you know your left and right limits, you know your absolute max, and of course, a good lender will tell you what your personal max is. Now, when I say personal max, I mean I've pre-approved tons of borrowers for $1 million, right? But that equates to approximately anywhere between $7,000 and $9,000 a month, depending on taxes and stuff. Not everyone's budget and appetite is up that high. So I always ask people, hey, regardless of what I can pre-approve you for, what budget do you want to stay in each month? Because that's more important. $1 million pre-approval is cool to brag about, but if you want to stay around $2,000 a month, it's nice to know what that's going to equal for your buying power. I say your because everyone's is going to be a little bit different. My $2,000 a month, Matthew's $2,000 a month, Joe Smith down the street's $2,000 a month could be different loan amounts depending on credit, location in the country, there's a lot of things, right? So I always like to make sure it's individualized. Once you know your left and right limits, though, if you are not already working with a realtor, you'll want to get linked in with one, because the next step is finding a home. You'll want to search, stay within your means, and talk to your loan officer and realtor as one team to ensure that everyone's on the same page, to ensure the realtor knows just how much seller credits we need to ask for, if any. So the buyer knows just how much this is going to cost them a month. It could be a perfect house, but if it's out of their monthly budget, they might not actually like it. So it's always nice to have that teamwork and that team mentality versus having two separate teams. Once you find a home, you obviously put an offer on it, go under contract once it's been accepted, and then you'll get your initial loan disclosures. You'll sign those up. That's just an initial snapshot about, hey, here's what we're thinking numbers are going to look like. It's a big estimate sheet. It's It's not set in stone. Your interest rate at that point is likely not locked. You probably don't have an insurance quote yet. Taxes haven't been finalized with the title company. There's a lot more to it. So it is just an initial loan estimate. Next, you're going to processing, appeals and inspections. That's where you get like your home inspection, termite inspection, septic well. Underwriting. Once underwriting clears all the conditions, which you may be conditioned for updated bank statements, updated pay stubs, or maybe you forgot to disclose that you actually pay child support each month and the underwriting saw it on your bank statement. So you may have to just provide more information. All underwriting is trying to do is gather all the information necessary to ensure that you are going to meet the requirements for that loan product, right? In this case, specifically the VA loan. It is underwriting's job to make sure after closing, when the VA gets the packet, that the VA says, yes, I will guarantee this loan. And we'll get into what I mean by guarantee in a few minutes. Next up, after underwriting greenlights us, you get the final approval, your initial closing disclosure. Some states and some sections of the country have a waiting period of typically 3 days that you have to wait before you can close, but some don't, so kind of state dependent. You'll get your loan documents at closing. You'll sign them up on your scheduled closing day. Your realtor will be there, your loan officer if they're local. Downside, I suppose, to being available to help in all 50 states is, unfortunately, I don't get to go to every closing, just the ones local to me. But either way, your lender, I'm sure, will be on standby via phone, right, if you have any questions. So a little bit of a history lesson, because not everyone knows how, why, or when the VA loan actually came to be about. So back World War II time frame, 1944, the Servicemen's Readjustment Act, which came to be known as the GI Bill of Rights. Essentially, the VA said, hey, these people are dying for our country. I'd like to make it easier for them to buy a piece of it. I don't think that they have a lot of money. Let's face it, especially back then. Military didn't get paid very well. Do they now, right? So the bank said, cool. Well, we use down payments as a risk mitigation, right? So that if they foreclose, we're not 100% liable for the full balance. They put 20% down or whatever. We can still sell it at a discount, but still break even or make a small profit as a bank. VA said, that's fine. We're going to give you an IOU for 25% as a guarantee that if they foreclose or stop making payments or what have you, or God forbid pass away, that we as the VA will give you, the bank, 25% of that original loan amount so that your risk is mitigated. Bank said, cool. And that's why that as long as you qualify, which we'll get into that, you don't have to put a down payment on a VA loan, which is so powerful. Biggest piece of it is the no down payment. Comparing that to like FHA and conventional, where 3%, 3.5%, 5%, depending on the loan amount, that can be a good chunk of change. Now, eligibility for active duty service members, it needs to be 90 days of continuous active duty after. Sorry, let me back up. I apologize that post-basic AIT is in the wrong section. That's for National Guard and Reserve. Active duty, let me clarify this. Active duty is starting day one. You sign your contract when you are officially, you're for the Army at least, it's pay entry base date on your LES. But basically the day you join the Army, the Marines, the Air Force, that is your day one. 90 days after that, you are officially eligible for the VA loan. So yes, during basic, that time counts. And during your advanced individual training, AIT is what the Army called it, that time counts as well. So by the time you get to your first duty station, you could, by all means, buy a home as long as you have met that 90 days. Now, for National Guard and Reserve, that's where that post-basic / AIT comes into play. Basic training and advanced individual, like your job training, does not count for National Guard and Reserve folks. Their time starts when they report back to their duty station, their home station, and they need to have at least 6 years of continuous service in the reserves or 90 days of active duty time, being activated, deployed, what have you. Why 6 years? Well, comes out, 1 weekend a month, 2 weeks out of the year, ends up adding up to about 90 days after 6 years. So 90 days is the magic number. Additionally, surviving spouses of service members who died in the line of duty and have not remarried can also be eligible for the VA home loan. The key there is not remarried. You do give up your benefits by remarrying, of course, if you don't marry another veteran. I mentioned a little bit of this just a second ago, but unique features of the VA loan. Biggest one, no down payment requirement. The VA is willing to guarantee 100% financing, which means no down payment. Putting it into perspective, 3.5% down for FHA on a $300,000 home would be well over 10 grand, about 12 grand. So that's, 10, 12 grand in your pocket, not needing to be spent. There's also no private mortgage insurance, also known as PMI. And what that is for FHA and conventional loans under 20% down, you pay an extra fee each month for not putting 20% down. So it's a little wild, but it's again falls back to that risk mitigation for the banks. VA loans do not have that. There's no additional fees for being 0% down payment. VA typically has the better interest rates. Now, I'm not going to say they have, 2% rates while everyone else has 10, right? Not that drastic, but in the grand scheme, apples to apples, VA typically has the best interest rates, then FHA, then conventional. Lastly, the limited closing costs. So there's not a huge difference, but there's certain things the VA does limit for closing costs. So again, it's just helping your out-of-pocket expenses be as minimal as possible. And we'll get into that a little bit as well in terms of the out-of-pocket expenses, kind of towards the end. But I do want to make it clear up front, the VA loan does have closing costs, just like every other loan has. Closing costs are going to be your title expenses, prepaids for insurance and taxes, escrows for insurance and taxes, the cost of your rate, the lender fees, everything, right? Because everyone has to get paid for doing their service during your loan product. So there are closing costs, but there's no down payment. So no down payment, but still potentially some out-of-pocket expenses, depending on how you structure your deal. And we will cover that. All right, so credit and debt to income. Two of the biggest things that'll either make or break you with the VA loan. And kind of two of the biggest things that people write themselves off for being eligible before even finding out that, no, they're good to go. So credit, we'll start there. Most lenders want to see a 620 or even a 640. I'm going to go ahead and call them out. USAA, Veterans United, Navy Fed, the big wigs, the big dogs, right? They're going to tell you 620 or kick rocks, unfortunately. Now, the VA themselves, per their guidelines, do not have any minimum credit score requirement. They have credit requirements, but no credit score requirements. By credit requirements, I mean like the internals. So they want to make sure that you're financially sound and likely to be able to make the payments. So those requirements look like no late payments or collections within 12 months, having proper residuals, which we'll touch on that, and just not having everything maxed out to the nines, because they want to make sure that they're guaranteeing a loan that is likely to get paid back, because they'd go broke if they had to just pay the guarantee on everyone's loan. But again, I want to specify this, big bold letters. The VA themselves have no minimum credit score. So if a lender tells you they cannot work with you due to your score alone, not because of the internals, or the score alone, let them know, thank you, I'm going to go ahead and look for somebody else, because I promise you there are lenders that go down to 500, 400, right? Now, I'm not going to say everyone at a 500 or a 400 can buy a house, because most likely at that score range, you probably have some recent late payments. You might have some collections. Maybe you had a foreclosure or a bankruptcy in the past. Those things don't just write you off completely, but getting with a lender that's willing to sit down and help you work through those issues and give you a game plan to overcome them will definitely put you in a better spot in the long run. Debt to income ratio. It's exactly what it sounds like. It is the ratio of your debt to your income. Now, debt, we don't care about how much gas you're paying, how much food you're eating each month, your Netflix bills. We're looking at debt due to your credit report, right? So all the debts on your credit report, Plus, if you have any child support, alimony, back taxes that you're on a payment plan, that'll be included as well, to your effective income. I say effective income because not all income can be used. A quick key point there is bonuses, commissions, and overtime. Those have to be averaged over 2 years and have a likelihood to continue. So if you just started getting overtime last year or this year, you're likely not going to be able to use that as qualifying income. It would just be based on your base income. So debt to income, again, that ratio, and just for simple math, right? If you have $400 of debt each month on your credit report and you make $1,000 a month in income, you're at 40%, right? Just divide the two numbers. So the VA recommends a maximum debt to income ratio of 41%. However, it is up to the lender to give their final say. Our specific example, we can go up to 60, 65. I've even seen as high as 70 get approved. However, I will say when it comes to higher debt to income, it is going to depend on residuals, and we'll get to residuals, as well as just likelihood of repayment, right? Someone who makes $2,000 a month, 70% of that would be $1,400. That means they only have $600 left over to pay for their gas, their food, their utilities, their, lifestyle. That's probably not going to get approved. But someone who makes $20,000 a month is obviously going to have $6,000 left over, which is more than enough. So it really does depend case by case how high you can go. I will say 60% is a typical industry standard limit. Now, again, we talked and touched on residual income. So what is residual income? Residual income is the amount left over after paying all your things each month, right? So you see the chart here. I'm not going to get too into the weeds on this in terms of location in the country and family size, but you take your gross income, any additional income, and spouse's income, take out taxes, take out credit report debts, take out estimated utilities based on square footage, take out child support and future or alimony, and child care, any future mortgage payments, and that's what you're left over with for residual. A lot of times lenders will want to see if we're using residual income as a compensating factor to maybe overcome the fact that our credit score is a little bit lower. We'll want to see at least 120%. So 20% over the VA minimum residual income. And that's, again, just to show that, yes, this person has plenty of income left over each month. Entitlement and certificate of eligibility. So again, we talked about entitlement, and just as a reminder, entitlement is 25% of your total loan amount, because again, the VA is guaranteeing 25% of that original loan amount. So again, entitlement, 25% of the original loan amount. You can use your entitlement until you run out of it. So another myth I hear all the time is you can only use it once, your VA loan. That is not true. I personally, at one point, had this house I'm in currently and 3 rental properties because they were the 3 previous homes I lived in, and then I PCS'd and PCS'd and PCS'd, and I just kept them, turned them into rental properties, and I had enough entitlement left over to purchase this house. Now, I have since sold those, and if I didn't sell those, I would have had to sold at least 1 or 2 of them to afford to move somewhere else, right? And we'll get into entitlement breakdown here shortly, but you can absolutely have more than one VA loan at once. Now, how does the VA afford to pay this, right? Because let's face it, veterans and non-veterans alike foreclose. It's just the nature of the beast. People are going to foreclose in the grand scheme of things, right? Not everyone, unfortunately, is going to, be able to pay their mortgage payment, for the rest of the time being. So if someone forecloses, again, the VA is paying 25% to the bank. On a $300,000 loan, that's $75,000 that the VA is paying the bank to offset that cost. So how does the VA afford to do that? Well, it's called a funding fee. The funding fee, unless you're exempt, and we'll cover exemptions, the funding fee is either 2.15% if it's your first time ever using the VA loan, or 3.3% if it's any time after that. Again, unless you're exempt from it. Now that percentage is not out of pocket. It is just tacked on to your loan amount. So a prime example, I purchased this home before I was exempt from the funding fee. It was a $300,000 home with my 3.3% funding fee. My total loan amount was $309,900. So your loan amount is going to be more than what you paid for the house. However, of course, that's much nicer than having to put down, 10, 15 grand as a down payment. Again, the funding fee varies based on the borrower's service type, and by that, whether they're currently serving or they're retired, veteran, and maybe have disability. Down payment, you can reduce your funding fee by putting a down payment. However, personally, I never recommend that. It doesn't math out to be profitable, in my opinion. And of course, whether it's first time or subsequent use. So let's talk about the certificate of eligibility, because that's the first thing a lender is going to need to see, really, to know if you're even eligible for the VA loan, especially if you're coming straight out of basic training in AIT, or you've been in the reserves for 6-ish years and you want to see if you're eligible now. You'll want to get your COE. Your COE, again, is your Certificate of Eligibility, which certifies that you are eligible for the VA loan. As a lender, we can pull it for you. If a lender tells you they don't have a way to pull your COE, they're just being lazy. And that's not what we want to see, right? So we as lenders have access to the system. We need your social and birthday and stuff, and we can pull it for you. However, I always like to teach how you could pull it yourself, because I think it's nice to be able to pull it yourself and see things and look things up on your own, right? Without having to rely on somebody else. First, you're going to go to the link on the screen here. If you simply Google va.gov space COE, it'll be like the first link. You'll come to this page and you'll click on the left-hand side, request the COE online. You'll follow the steps, sign in with your CAC or ID.me or however you're going to log in, and then follow the prompts and it'll pull your COE. This is my personal COE from about 2 years ago now, but it still has all the pertinent info we need. Reference number, not too bad, but of course I've locked out my social security. You see you have your name at the top, your social security number. You want to make sure those things are accurate, as an underwriter is going to verify those things. And if they're not accurate, that can hold you up in the process. Entitlement code just depends on what period you have served in the military, right? Vietnam era, Gulf War era, global war on terrorism, branch of service, and funding fee exemption status. Again, at this time, my exemption status was not exempt because I had no service-connected, SC, combined percentage. So we'll talk about that. At the top middle, you can see your currently used VA loans, the loan amount, the date of the original loan, and the entitlement charge and the status. Underneath, this is what trips people up a lot. If you've never used your VA loan before, this right here, where my mouse is, will say the veteran's basic entitlement is $36,000. Now, if you read the fine print, it's not necessarily worded the best. If Robert got to redo the COE, it would look a lot different. But essentially, if you read it, it states that the basic entitlement is $36,000. That covers your first $144,000 of purchase power. So if you buy a home that's $100,000 or $140,000, no matter what, you're going to use up $36,000 of your entitlement. Now, if you buy a home that is $300,000, it's 25% of that amount, so $75,000 in that case. And it explains it there. You can see who it was issued by, the date it was issued, and the conditions at the bottom. So conditions, of course, valid unless discharged. Of course, then you'll want to pull a new one if you've been discharged, dishonorably. You're not going to have your VA benefits. Other ways, you can also lose it as well. Subsequent use funding fee. This is stating that the veteran, myself, must pay a subsequent use funding fee on any future loans unless they are exempt from it, meaning I'll have to pay that 3.3% instead of 2.15, unless exempt, which I am currently now. Funding fee. Veteran is not exempt from the funding fee. At that time, I was not. And funding fee refund. So we'll get into how you can be exempt, but biggest way is being rated being VA rated, right? Disability rating. As long as you have at least 10%, you're exempt from that funding fee completely. The cool thing, and this is what it means by the refund, the cool thing is if you close on your loan on July 1st, you officially own that house, right? You paid your funding fee, but you filed for disability and it got backdated to even June 30th, the day before you closed, but any day prior. As long as your disability is backdated properly, you'll actually be exempt from that funding fee and should have been exempt, and you'll get refunded that funding fee back to your loan amount. So it'll reduce your loan amount and reduce your monthly payments. Your lender will essentially recast your loan and fix that for you. So pretty cool. Of course, at the very bottom, it tells you that a lot of states have their own veteran benefits. So go to that link and look up any maybe local property or vehicle tax relief. So again, looking at the top here, just a more zoomed in view, loan numbers, states that you closed in, loan amounts, entitlement charge. Now, the entitlement charge should always be 25% of the loan amount, unless you go in with another veteran, i.e. you're married to the veteran or it's your buddy and you want to buy a house together. We'll get into how that works. Then, of course, it would be about 12.5%, right? Because each of you would use half the entitlement. Talking about the funding fee again, 2.15 and 3.3% if you don't put a down payment, which is what 99% of veterans choose to do. If you do put a down payment, your funding fee is reduced. However, again, in my personal and professional opinion, it is not worth putting a down payment solely to reduce the funding fee. It doesn't work out monetarily. All right, exemptions. So not everyone is required to pay that funding fee. Again, the biggest reason why you would not be would be VA disability. So veterans who receive compensation for service-connected disabilities, veterans who are rated as eligible to receive that compensation based on a pre-discharge exam or review. However, the caveat there is like if you're being med boarded, right, and you know what your rating is going to be, we do need the official benefits letter stating you are rated, not that you're going to be rated, but you are rated at this amount. You might not be getting paid for it yet because you're still in, but you need to be actually rated. Again, veterans who are not receiving but could because they're on active duty, Purple Heart recipients, and again, surviving spouses who are eligible. Again, biggest thing there is not being remarried, or if they do remarry, of course, marrying another veteran. So let's talk about the 3 S's. The 3 S's of a VA loan is essentially a rule of thumb on how to identify what house may or may not actually qualify for the VA loan or be eligible for it. The 3 S's are going to be sound, safe, and sanitary. Now, you can read all that, but essentially sound, structurally sound. Is the house falling apart, or does it look like someone sneezes next to it and it's going to fall over? Safe. Typically, the biggest safety concerns are going to be stairways having handrails, whether that's going upstairs or like to a porch, fireplaces being properly ventilated, and then electricity, electric boxes being wired, up to code. Sanitary, biggest thing, right, is sewage backing up into the bathtub. Yeah, that's pretty much the biggest sanitary thing I've ever seen. But like it does say, each place you purchase needs to have a bathroom, needs to have suitable living spaces, sleeping spaces, and cooking and dining spaces. So it's got to have somewhere to cook, sleep, and sanitary, right? Use the bathroom. So what can you buy? After we know kind of what we're looking for, what types of things can you buy with a VA loan? So a lot of red X's here, and I put them, a few of them are a little bit, jokes, but a couple of them are things that people have actually asked me about. So if it's completely dilapidated and run down and not livable at the time of purchase, you cannot purchase that with the VA loan. You can't purchase yurts, kind of super, super unique, cool things there. While you might be willing to live in that full time, it doesn't have the proper, bathroom, kitchen type deals. Obviously no outhouses, no large apartment complexes. However, we will get into multifamily. No mattresses on the side of the road, no camper vans or campers, and no manufactured mobile homes that still have like the axles and the trailer hitch essentially movement things. We'll get into that in a moment, attached to it as well. What you can purchase: multifamily homes, manufactured homes on a permanent foundation, and of course, standard single family homes. So the standard single family is going to be what you see in almost every neighborhood, and 99% of houses, if I had to put a number on it, are going to be a standard single family home. Most likely, VA borrowers will be buying this, and there's no limit on bedrooms, bathrooms, acreage, size, in terms of like how big. So, if you find that 50 bedroom, 13 bathroom, 600 acres, 10,000 square feet, you're good to go as long as the lender approves it. Everything I'm talking about with the VA loan always comes with the caveat of the lender has to allow it and approve it. I want to put this caveat out here now. Lenders are always going to have their own overlays. Some lenders don't want anything over X amount of acreage, right? 100 acres, 200. Some lenders don't want the land to be worth more than the house, right? Some don't want super unique houses. It all comes down to risk level by the bank, and typically it boils down to, if the veteran forecloses, how quickly and easily could we resell this, right? And that's why they don't always like super unique things. 2 to 4 unit residential multifamily. Now I say residential because it cannot be listed by like the county or any tax purposes as commercial. It must be residential, and maximum of 4 units. So duplex, triplex, quadplex. The veteran must occupy 1 unit of the multitude, right, of the building, I'll call it. Maximum of 4 units. They must all be attached. As you see here, it's all one foundation. They're all attached. It can also be, townhomes, so tall skinnies, right? It can be just one large building with 4, 2 entrances downstairs, 2 entrances upstairs, right? Whatever it may be. There's a lot of different ways it can come, shapes and sizes, but it must be attached, and it must be on the same foundation, and it must be no more than 4 units residential. Now, often veterans find that multifamily homes are going to be more expensive. Of course, it's more home, but of course, it has the potential to pay for itself. My first multifamily, which was my 3rd home, the 3 units I did not occupy, it was a 4-unit building, actually paid all of my mortgage, all of my utilities, and put money into my pocket. So I quite literally lived for free. That does not happen all the time. And that was before COVID, before prices shot up. So is that happening now? I don't know. However, you can definitely use that as an investment tool. Live in 1 unit, pay a normal mortgage, right? Because the rest of it is offsetting some of your mortgage. And then of course, down the line, if you ever move, you can rent that unit out and just keep that as a nice, rental property. To be able to qualify for these kind of higher amounts that these multifamilies, may come at, the VA allows up to 75% of the appraised market value for the rental for each other unit. So if you have a building that each unit is going to rent for $1,000 each, obviously the veteran is going to live in 1, and you can take 75% of each of the other $3,000 market rents that the appraiser, when he does his appraisal, finds. So you would take 750, 750, 750. I think that comes out to about 2250 that you'd be able to add to your already existing income to help you qualify for this multifamily home. And manufactured homes. So yes, you can buy a double wide or a single wide. The caveat is about fourfold. Manufactured after June 15th, 1976. So the original manufacturing plate, we'll need to say a date after that. For double wides, 700 square foot minimum, and for single wides, 400 square foot minimum. Must be permanently affixed to the foundation. So no axles, no wheels, no trailer hitch, nothing that can allow it to be easily moved. And again, it must be secured permanently to the foundation. And again, all towing gear must be removed. Another one that I didn't add to this list, it must not be moved more than once. So from the original factory, it can be placed on a property. If it ever moves from that property again, it is no longer eligible for VA or FHA actually financing. So again, you want to make sure it's never been moved. It's a question that you'll want to ask your realtor to ask the seller. Has this ever been moved from this property? So we talked about entitlement. We talked about how I personally had multiple properties. And again, if you want to and can afford it, you can have multiple properties to include some rental properties. But what if I run out of entitlement? So let's first talk about how you would run out of entitlement, right? What's the limit? So in 2025, we'll talk 2025 numbers. They do change every year. But in 2025, if you do not have a VA loan being used currently, whether you've ever had one in the past or not, it doesn't matter. If you do not currently have one, the sky's the limit. You could purchase a $6 million home as long as a lender approves you for it, and the VA will still put 25% guarantee on that home. Now, once you have a VA loan being used, you're bound by what's called the county conforming loan limits. Long way to say a limit, right? So in 99% of the United States of America, it is $806,500 in 2025. Now, Hawaii, Alaska, and some counties in the States, like near DC, LA, New York City, some of those really, really high cost places, I don't have it memorized, unfortunately. I guess fortunately, I don't run into that issue too much, but it's a little over 1.2 million. So if you're purchasing in one of those counties, you have a larger cap. But the quick math is if I bought my first house and the original loan amount was $200,000 and I want to keep it as a rental property and buy another one, you would do 806,500 minus the original loan amount of 200. And that means as long as you qualify financially, you can purchase up to a $605,000 or $606,500 home with 0% down. Now, if you only qualify up to $400,000 from your lender, then of course that's your limit. But if you qualify at $800,000, you would still be limited to that 600 and some change for 0% down. If you want to go over that, you have to put a small down payment on the difference. So let's say you've used up all $800,000 of that entitlement, whether it's on the first house or you now have 3 or 4 and you're just at that limit. What happens? Well, of course, you can either sell one of your homes. Maybe it's your current home because maybe it's not going to make a good rental property. Maybe it's one of your old rental properties that have appreciated a lot and you're going to make a lot of profit on it. You can either sell them. Now, when you're selling a home, it needs to be sold before you close on your next home. So, it needs to be sold so that we can see that it's off of your certificate of eligibility and the entitlement has been freed up. Alternatively, you can refinance out of the VA loan into a conventional, and it's called a one-time restoration. However, it's a bit silly that it's named that because you can do it as many times as you want. It's not just a one-time thing. But let's say I have, for simplicity's sake, 4 properties that all originally cost $200,000. So I don't have my VA loan entitlement available anymore. Maybe I want to buy a $400,000 house. I would refinance 2 of those homes into a conventional loan. Of course, interest rate's going to change, etc. I got to make sure it makes sense for my rental properties. But that would free up $400,000 of your entitlement, allowing you to then purchase another home up to however much you released. So different flavors of the VA loan. It's not just a single serve, just buying a house. There's actually a lot of cool things you can do with your VA loan that not a lot of people even realize, lenders included, unfortunately. So biggest thing that's kind of been getting a lot of traction lately is the VA one-time close construction loan. I'm not going to go too deep into it. That's a whole nother webinar in of itself. But essentially, it's a one closing construction loan that ties in the land and the build cost all into one loan with no payments due until the construction is completed, which can be up to 12 months. So you could be building a very unique custom home that you love on a specific piece of property and not have any payments out of pocket for that home until it's actually complete. Dual VA loans. So again, like I talked about earlier, husband and wife, husband, wife, wife, they're both veterans and they want to combine their remaining entitlements. Maybe they each have a home in their name already, so they don't have their full entitlements. They want to combine the remaining entitlement to purchase that larger amount home. That's okay. However, you don't have to be married. If you and your buddy want to go in on a house together, maybe you're just tired of living in the barracks, you can do that as well. Excuse me. However, the caveat is anyone on the loan needs to make sure, apologize everyone, needs to make sure that that house is going to be their primary residence, as that is a key factor of the VA loan. It has to be your primary residence. 3 more flavors. VA rehab. This one's really cool. I think it's very, very underutilized. It's a renovation loan that allows you to take the home purchase, the home renovations, yes, there's a few fees and stuff included, and tie it into one loan, purchase the house, and make the improvements directly afterwards. It needs to be done with a general contractor. You can't do it yourself. And you still have to qualify for the full amount, of course. You know, there's some caveats to it, but you know, if you find a perfect house, perfect location, it's got great bones. However, it's still from 1980. You want to redo the kitchen, the bathroom, new flooring, new paint, etc. The VA rehab or renovation loan could be the way to go on that one. Saves you from having to go out of pocket for that money after you purchase it. Interest rate reduction refinance loan, also called an ERL. If you've ever heard ERL, that's what they're referring to. It's exactly what it sounds like. It's an interest rate reduction, so reducing your interest rate, refinance. You're not getting any cash out. You're not getting any cash back. You're not, you know, eating up your equity, taking cash out. It's just a streamlined refinance with minimal costs, minimal paperwork, and it can help you reduce your interest rate if the market's gotten better. Now, for that, you do need to wait, and in general, right, any refinances, you do need to wait 6 on-time payments after you close on the home before you can ERL your VA loan. Personally, and kind of industry standard, you want to make sure you can get at least a 0.5% better rate before it starts to make sense. And of course, you want to make sure you're not buying your rate down too much, because of course you're going to be using your equity to pay for this. So you don't want to tie up a lot of your equity. That kind of goes for any refinance. And then VA and non-VA team up. So veteran and their son or daughter, veteran and their brother or sister, or their mom or dad that's not a veteran. If a veteran and a non-veteran want to go into a loan together and they are not married, because if they're married, it doesn't matter. Your spouse does not have to be a veteran. They can be on the loan with you. But if it's your buddy and they're not a veteran and they want to buy a house with you, again, they do have to sign saying they're going to live there too. However, the VA does not cover their portion of the loan. So the veteran would take half the loan. The VA would put 25% down. The non-veteran would take the other half of the loan, and it has to match what the VA put into it, 25%. So obviously half of 25% is 12.5. I apologize for that typo, not 14.3. That's what it used to be. But 25% divided by 2 for their half is 12.5% of the total loan amount. So for a $400,000 loan, you would be paying 12.5% down on the $400,000, which is the same as 25% on the $200,000. All right, so we touched on closing costs earlier. Let's go ahead and talk a little bit more about it. Again, I made sure to mention earlier that the VA is 0% down. However, it does still have closing costs to pay for things and pay for services and prepaids that are happening during the loan process. Typically, it's anywhere between 2 and 6% of the total loan amount. If anyone tells you it's always a number, they're blowing smoke. Excuse me, they're blowing smoke your way, because it varies a lot. The reason closing costs can vary is tax exemption if you're 100% disabled veteran, your personal insurance quote, the property's tax tax bill, your title company's fees, your lender's fees, the rate buy down, depending on how far, if at all, you buy your rate down. So it can vary. For higher credit, you're going to be probably closer to that 2 to 4. For lower credit, you're probably going to be closer to that 4 to 6, right? Again, it is very person to person, scenario dependent. It covers, again, your rate, lender fees, title fees, escrows, prepaids for taxes and insurance. And it can be 100% paid for by the seller. So when you hear folks saying, no, I didn't have any closing costs on my VA loan. No, I got those rolled into my loan. No, the lender paid for them. In 99% of the cases, that borrower, that person is just misinformed or misunderstanding things. Lenders typically aren't going to pay your full closing costs. They may give you a lender credit to help out, but they're typically not going to pay all of it. You can't just roll the closing costs into your loan. There's a way around that, but you can't just roll it in. So 9 times out of 10, the seller paid for them. So when you structure your deal, let's use 5% closing costs for a number. 5% of a $400,000 purchase price is $20,000, right? So could be that much, could be less, of course. The seller can absolutely, if you include it in your offer, pay $20,000 towards your closing costs. You would just want to make sure you get with your lender for that specific property and ask, hey, what's our estimate on this? Where are we looking around? And I try and overestimate personally for my clients because I'd rather them get more money than they end up needing rather than vice versa. But if your lender says, yep, 20 grand for this house, cool. Hey, Mr. Seller, I'm going to offer you $400,000, but I want $20,000 in seller credits. If they accept it, awesome. Now, I say there's a workaround to being rolled in because if they say, no, we just don't have the money for it, like we're not going to have enough profit on this loan to pay that. Well, as long as the house appraises, you can actually increase that offer. So if your realtor firmly believes that house can appraise for $420,000, you can tell the seller, hey, I hear you. Well, what if I give you 420 and you just give me 20 back at closing, of course? Well, then they net the same and it can be beneficial for both parties. You'll hear sometimes a 6%, and majority, if you hear a number, you're going to hear someone say, oh no, seller can only pay 4% of your closing costs. That is not true. Again, sellers can pay 100% of it, even if it exceeds the normal of 6%, or the high normal of 6%, because your insurance might be crazy high, your taxes might be crazy high, so it might push that number higher. The 4% comes into play, and realtors get this mixed up a lot. The 4% comes into play only for prepaids and consumer debts. So if as a borrower, you need to pay off one of your credit cards to qualify for this house, as long as you get the seller to agree, the seller can actually pay that off for you. And again, prepaids also include your prepaid taxes and prepaid insurance. But yes, absolutely, you can use seller credits, seller, closing cost assistance to pay off personal debt, right? Credit cards, personal loans, stuff like that. So pretty cool. Some misconceptions that we're going to get here and we're going to tear down. So big 3, I can only use my VA loan once. Not true. We've talked about it. I've personally lived it. You can absolutely have more than one VA loan at one time. Sellers can only contribute 4%. I just dispelled that. The 4% rule is only towards your prepaids, so prepaid taxes and insurance, and consumer debt, personal loans, credit cards, etc. I need a minimum of a 620 credit score to qualify for a VA loan. Absolutely not true. That's the biggest one I hear. Absolutely not true. A lender sets the credit score number limit. However, the VA does have minimum credit guidelines. So you may find a lender that can go down to 500, but if your personal situation doesn't qualify with that 500, your lender should be working with you to help clear those things off your report, give you some guidance, and get you up to, where you need to be. Excuse me. Now I want to touch really quick on home warranties versus home insurance, because I get this question quite a lot, actually. So sometimes you'll hear a seller saying that they're providing a free home warranty, right? A 1-year home warranty, or a lender might say it. Or you might get just reached out to by a company and say, hey, I saw you recently bought a house, we offer home warranty, etc. Don't get that confused with home insurance. Home warranty protects your investment in terms of like the internals, right? So the home warranty is going to cover major systems like your HVAC, plumbing, water heater, kitchen appliances. It helps with the repair and replacement due to like wear and tear, electrical outage, shortage, whatever, it's usually pretty cheap. $300 to $600 a year is not out of the normal. So that's obviously less than $50 a month. And it's great for VA buyers and anyone, right, who wants peace of mind knowing that, yeah, the house I'm buying isn't brand new. The water heater's kind of, HVAC's a little older. With the home warranty, you know that if it just kicks the bucket, that the home warranty is going to kick in and help repair or replace that for typically no deductible. Do not quote me on that, though. Every company is a little bit different. Now, homeowners insurance protects the bank. Warranty protects you. Insurance protects the bank, right? Because the bank technically owns the house until you pay it off, right? The homeowner's insurance is going to cover structural damage, theft, natural disasters. Typically, that's the case, right? Fire, storms, floods, and liabilities on the property. So that if someone sues you, or tree falls down, or hurricane, and it destroys the bank's asset, they know that you have something in place, the insurance, that will repay to build back what you lost. It's required. Unlike home warranties that are not required, home insurance is required by lenders on VA loans to protect the home's value. It can cost very, very wildly. I've seen homeowners insurance for $900 a year. I've seen homeowners insurance for $6,000 a year and upwards, right? So it is very person dependent. It's based on your personal insurance history, credit score, home value, etc. But every homeowner needs it. Every homeowner should want home warranty. Again, home warranty is going to cover your 0% down. That way you're not having to shuck out $5,000 on water heater and AC and all that, right? Just because they kick the bed. Key takeaway, again, insurance and warranty, two different things. Seller concession cheat sheet. Because unlike the other loans, the VA does not have a cap on how much the seller can pay. So when you hear someone say there's a limit, they're probably thinking of a different loan. I won't go into it all here, but you can see, feel free to screenshot this. But do note that closing costs and discount points are unlimited for the VA loan. Prepaids and debt payoff is the 4% cap that you might hear. All righty. Any questions for myself, the Veterans Alliance? That is the meat and potatoes of everything. Any questions anyone has saved, please go ahead and ask them now. Let's see, I don't think I see
I'm gonna
anything in
check the
Q&A.
Q&A. I didn't see
I don't think
anything
I
in the
see.
Q&A. And it
Sylvia,
doesn't.
I granted you permission to talk. I gave your permissions on here. Sylvia, I'm not sure how soon you jumped into the webinar or how recently, but what questions do you have, if any? And if easier, of course, there is my QR code here. This takes you to my personal calendar. You can schedule up a one-on-one with me. Again, screenshot, take a picture of this, and it'll bring you again straight to my calendar, set up a time. We can go into any personal questions, anything that someone doesn't want to share on the call, and of course, anything that you think of after the fact. If you're like me, and as soon as we hang up, you'll think, oh, shoot, that's what I wanted to ask him, by all means, schedule something up with me. Additionally, Veterans Alliance, again, the ones hosting this awesome webinar, their QR code is there, and this is, of course, a photo of their home screen. Awesome resource. I personally used it myself, just asking questions and looking at the resources tab. So tons of great stuff here. Matt, I'll give it back to you if there's anything you want to specifically say.
Okay, yeah. If we don't have any questions, I just want to thank everybody who had joined the webinar today. Thank you to Robert for taking your time out of your day to
Absolutely.
volunteer your time to be our speaker today. A lot of great information, a lot of information that even myself that I didn't exactly know. So I even learned something today. So if we don't have any more questions, I'm going to say everybody have a great evening wherever you are in the time zone, or late afternoon, and just have a great day, and hopefully we see you guys in future webinars.
Absolutely, Matt. Thank you for having me. Really appreciate this opportunity, and I'm happy Anytime you guys need some assistance or questions answered, obviously here's my card. Feel free to screenshot this. We'll back it up to the va.org Veterans Alliance webpage, QR code there. And then, of course, any specific questions or one-on-ones with myself, my QR code here. Thank you, Matt. Appreciate you having me.
Thank you, Robert.